Welcome back to Financial Independence 101, the place where you go to get motivated, excited to make money, save money, invest money, become financially independent. And I'm Mike, your host today for Financial Independence 101. Today I want to talk to you about the 15-year mortgage versus the 30-year mortgage and why I'm a big fan of paying off your house, having no debt. So obviously, I'm in on the 15-year mortgage. I'm going to give you the pluses and minuses to both. I'm going to give you real world examples. I'm going to give you my personal real world example, and we're going to go all into this coming up. So it is the American dream to own your own home. A lot of people work their whole lives so they can own their home and, of course, own it outright. Now, today we're going to talk about the 15 versus the 30-year mortgage, and I'm going to start with the 15-year because I do like the 15-year mortgage the most. Now, obviously, you can go get a 10-year mortgage. You could get a 5-year mortgage. You could get a 40-year mortgage. There are so many more options out there, but generally, the deciding factor comes down to 15 versus 30. And if you're going to want to lean in one direction or the other, you could actually go to another extreme. But the most commonly written mortgages are 15-year, 30-year. And the reason for that is just because those make the most sense, more practical for the most people out there. But you could get a loan customized for you. I want to point that out. But starting with the 15-year mortgage. First thing I want to say is you do get a lower interest rate. So one of the more attractive features to a 15-year mortgage is having that lower interest rate. What that lower interest rate does is it effectively lowers the amount of money you're going to spend on interest over the course of the entire loan. And it also affects how much interest you pay in the first year, second year, every year. And that lower interest rate could actually help you out in the long run if you have the same goal I did, getting your house paid off and then never having to make another house payment again for the rest of your life. And the lower interest rate on the 15-year mortgage helps you get to that goal. The next one I want to say is that the 15-year mortgage, based on the amortization schedule, you are paying on that principal more towards the principal with each payment faster, getting closer to getting it paid off much quicker than a 30-year mortgage. Now, we could get into talking about with a 30-year mortgage on paying extra payments. But the reality is, if you're just looking at them and not doing anything more and just making your payment, you're going to pay down more so much faster. And of course, that leads to my next point, which is pay it off earlier. Now, more than just paying it off earlier, I can comprehend what 15 years feels like. When I bought my first house at 24, I knew what 15 years felt like. Well, that was when I was 9 to now, that's 15 years. I know what that feels like. When you're 24 years old buying your first home, if that's your age and you buy your first home, how do you know what 30 years feels like? You really can't comprehend that. And if your goal at 24 is I want to not have to have a house payment again, then the 15-year mortgage makes a lot more sense. And just get your mind around that. How are people making commitments to something they don't even understand fully? Like you can understand conceptually, but you can't fully understand what 30 years is. You haven't lived 30 years. Next I want to talk about is peace of mind. Knowing that with each payment you're getting so much closer to paying off your house. That gives you so much peace of mind. And I used to love looking at the statement when I would get my bill. Yeah, a lot of people would cringe, but I already had my budget planned, and I was like, how much closer so I could get this thing paid off? What's the principal down to? What's the principal down to? And I did a whole mathematical calculation, and when it gets to this point, I might just pay the whole thing off. But the 15-year mortgage has some downsides versus the 30-year mortgage that I really have to point out, and I want to get into this so everyone knows what they're going into if they follow this. First thing is you're going to have a much higher payment. Now, your payment per month is going to be higher. We're going to see that in the later example. I'm about to have an example for you and show you that, and show you the difference. But having that higher house payment is good on one hand, but a lot of advocates for the 15 years say, well, you could free up more money. You could have more disposable income because your 30-year payment will be lower because you have, of course, more payments on a longer time horizon. But not everybody's going to save that money, right? And this is guaranteed that as long as you're making this payment, you are going to stay on track. You have less financial flexibility. What does that mean? Well, that means that you are trapped into that payment forever. Now, of course, you could refinance down the road, but we're not talking about all that. We're talking about just 15 versus 30. So you have to be making that payment. If you lose your job, you still need to make that payment. Whatever happens, you still need to make the payment. And you need to make it on time, not late. Keep making that payment and not default on it, not walk away from it. It is a commitment you made for 15 years. You need to uphold it. In my belief system, in my book, very rigid. Make that house payment. Do not lose that house. The next negative is you lose your tax incentives really quick. So the thing is, the first year on my mortgage, I itemized and it helped. I was like, "Ooh, yeah, this is cool," you know. But then in the back of my mind, I thought, I'm throwing money away on interest just to get a tax incentive, which I don't like that. And when I no longer work anymore and I have my own ways to get my own tax incentives, I'm not going to need a house payment to do it. I'm not going to need to throw $20,000 or $30,000 a year away in interest payments just for a tax incentive. But the reality of it is, you don't have a tax incentive. After about 5, maybe 6 years into my mortgage, I stopped itemizing because it just wasn't enough. I didn't waste enough money in enough other areas to itemize, to make itemizing worth it, and therefore I didn't receive any tax incentive for paying and wasting that money on interest. Now I want to talk about the pluses and minuses to the 30-year mortgage. So take everything I said about the 15 and flip it upside down and switch all the points, which is exactly what I'm going to do, but I'm going to do it with a little bit more finesse, hopefully. So the reality of this is the 30-year mortgage, you're going to have a lot more flexibility in this. So meaning that if you need, let's say halfway through this, you decide you want to buy another car, which to me is a bad decision to buy another new car. Buy your cars with cash, save up, buy with cash. But anyway, let's say you decide to do that. You have the flexibility to do that with your 30-year fixed mortgage because your payment is so much lower, which means that you have options. You have more options. It's less rigid. So a lower payment, giving you more flexibility and flexible options is something that's out there. But you know what? A lower payment and having more flexibility means that you're probably not putting that extra money to work somewhere where you should. And I've seen this happen a lot. I know it's a plus, but this plus can turn into a minus very, very fast that, oh, I've got this extra money, I'm going to blow it. As opposed to a 15-year mortgage where you know you're going to an end. And the means to the end is that payment. And yes, back to the old tax incentive, you actually do get a better tax incentive because you are going to be paying more interest than principal for much longer on your 30-year mortgage because the amortization schedule shifts. Your breakdown of how much goes to principal and how much goes to interest is different each month because you're looking at a 30-year time horizon versus a 15-year time horizon. So you're paying it off a lot faster with the other one. But this one you get the tax incentives, which I didn't get to enjoy. So those are really the only two benefits. Looking at it, you're going to have higher rates. So let's get into this negative. You're going to pay a much higher interest rate. 0.5%, 1%, depending on different factors. And I'm going to go into these examples very soon. And then the higher interest rate in there is just really built into the loan. So it's really going to make you feel like you don't notice that. But that also goes into how you can get more. So I mean, that's kind of part of your benefit. You got a higher interest rate and you have more that you can claim on your tax deduction and all of that. But it depends on how you look at the money. When I look at money, I want the house paid off. This isn't helping me. Also, there's that long time horizon. Like it's going to take forever to pay that thing off. 30 years is a long time to pay something off. Now, everybody says, well, if you get a 30-year, a couple of months, you want to put a little extra money towards your principal, you can do that. And the reality of it is, yes, you can, but most people aren't going to do that. The reality is, most people are just going to pay their minimum. And if you don't have a solid plan, then how are you going to succeed? And I think a 15-year is a solid plan. And obviously, I've already told you, 30-year, the points are opposites to the 15-year. I did not talk about this point in the 15 years, so I'm going to talk about it in the 30-year. Is over the course of your entire mortgage, you're going to pay more. You will pay more money in a 30-year than a 15-year. So let's get into these examples so I can show you. So looking at this, I put in my mortgage for $88,500 that I got in 2001, and I wanted to make all the numbers match what I had, and I realized using this calculator that I used that it's actually not going to work very well. So it actually puts in more or less modern day interest rates. So I left that alone because I did not know what a comparison rate would be precisely back in 2001. But these numbers are sort of going to be helpful so you can get an idea. Now, looking at the very top, you see 88.5. Next box down, you see a box and it says what's your down payment. I put it at 3,000. It went a standard like 40,000 down, which I thought was crazy. But anyway, with an FHA loan, you can put down as little as 3%. And if you go with a traditional loan, you need 5 or 6%. So it depends on how you want to do it. But I mean, in my mind, I'm like, why are you, if you're needing to borrow money, do you want to put the most down? You want to put the least down? I would actually suggest to put the most down that you can. But the reality of it is, if you're financing it, it's because you need the money. So getting as little down to get into it, and then working on paying it off is actually a good way to do it. That's what I did. But of course, if you look at the very top of 88.5, I was approved for 311,000. So I was approved for 311. I bought 88.5. This is also part of when I get into my minimalistic lifestyle and how I lived off of only 25% of my income. This is how. This is one step of it. Also looking into the down payment percentage, it's calculated at 3.4, and for the FHA loan that I took out, I only needed a 3%, so there it is. Now, go out down below that, you see the boxes of the 15-year and the 30-year. So you have both comparisons side by side. That's why I love this calculator right here. And with the 15-year, this option was a 3.4%. 30-year was a 4.1%. So going down a little bit more, you can see that the blue number at the bottom in the summary on the monthly payment is $607. Now, I do want to tell you this is principal and interest only. This does not include what they call your escrow. Your escrow account, where most mortgages are going to require you allow them to pay your property taxes and your insurance on the house. And the reason for that is so that they know for a fact it's getting taken care of and paid for, and that their loan isn't going to be compromised because of it. So then you look to the 30-year, it's $200 less. So competitively, let's say for an $88,500 house, you're probably going to pay approximately $200 a month in taxes and insurance. So if you look down there, your 607 is up to 807, or your 413 is up to 613. So you're saving about $200 a month. If you went 30-year, you're paying a little less than $200 more for a 15-year. Now, down at the very bottom of the life of your loan, you're actually going to spend about almost $30,000 more to go 30-year. Now, this is a very, very small example. The numbers don't look that far off, and it's like, oh, well, that's just not that big of a deal. Well, the reality of it is kind of a big deal, because you're actually going to be spending 25% more on your monthly payment to pay it off in half the time. Example number 2 is on a $200,000 house, which I think is the average, national average. Anyway, so I did calculate $6,000 down, because that would be a 3% FHA loan. And also below that, it shows you the same interest rates. Going down below that, it shows you under the 15-year, you're paying $1,377. Now, I would venture to say at least $300, if not $400 a month in your escrow. So let's just up that. So you'd be paying $1,777 a month, or you'd be paying $1,337 a month. But any way you slice it, you're paying approximately $440 more a month to pay this off. So you're paying about 50% more to pay it off in half the time. And that's pretty consistent over the course of this. But now you got to look at the bottom, and you can see that you're going to spend $90,000 more on this loan. To buy this house, it's going to cost you $90,000 more. Now, one thing that people do discuss is that, well, interest rates are low right now. But guess what? Today, at the end of 2019, interest rates are still expected to go lower. So I want to hear from you guys. What do you think about the 15 versus the 30? Which one would you prefer to have? Which one have you done? Did you do one and wish you did the other? Let me know in the comments below. Like, subscribe. Financial Independence 101!